It could have been a lot worse today if not for the better-than-expected GDP report out this morning. Investors still worried about the corporate outlook and, of course, Apple's disappointing results last night.
Then you have uncertainty that remains over the upcoming election, the looming fiscal cliff, and we go on and on. Here to help us break down the markets in today's closing bell exchange, CNBC contributor Stephanie Link, our own Steve Leisman, Stuart Freeman of Wells Fargo Advisors, and in a moment, Peter Schiff.
Yeah, I mean, it's an important product, and of course the growth rate of Apple, it's like a smaller technology company that's dependent upon innovation and the next product. They are putting out new products a little more quickly now, which I guess suggests that it's a tougher economy. But by and large, I think that as we see more liquidity helping this economy, we see Europe bottom next year, which we really think we will in the middle of the year. The story is a lot more than about the general international economy than Apple.
Right.
I mean, I think that the market will concentrate much more on some deep cyclical companies that are coming back.
We want to bring in Peter Schiff, CEO, Euro Pacific Capital. Peter, let's talk about how you want to be invested in this market here. Would you be allocating money to stocks here?
Well, globally, yes, and we still have money in U.S. stocks, but I think this GDP report is very weak. Business investment was flat. That's the lowest in about 3 years. You have government spending rising sharply due to increased debt. That's not a growing economy. As far as I'm concerned, that's a contracting economy, and I still think that we're underreporting inflation in this. I think inflation is a much bigger factor than the government admits, and so in an inflationary environment, you want to own real things, but I think there's better opportunity abroad and also in natural resources and in precious metals.
What would drive the inflationary forces, though, Peter, if we keep hearing from companies about a decline in demand or a slowdown in the pace of demand for their products and services? Where does the inflationary pressure come from, other than, I guess, the Fed monetary policy?
Well, that's where it comes from. It comes from the Fed fighting the market, trying to restructure the U.S. economy. You have deflationary forces being applied by the market, which is what the economy needs, but the government is resisting that. The Fed is resisting that by creating a lot of inflation, QE, and the Fed has already stated that it's going to up the ante significantly at the end of the year. We're going to be printing over $1 trillion a year, and probably even more than that, because all this money creation is not going to grow the economy. It will create inflation, it will debase the dollar, but that's just going to make the underlying problems worse.
So in terms of the election, do you think that loosens things up? What's the catalyst to get us out of this then, Peter?
But we're not going to get out of it. We're just going to go deeper into it. Unfortunately, even if Romney wins, we're going to continue to repeat the same mistakes. Obama is repeating the mistakes of Bush. The Fed is still there. Ben Bernanke's been repeating the mistakes of Greenspan. So I don't think we get any real change until we have a monetary crisis, until we have a sovereign debt crisis. Unfortunately, that is looming on the horizon sometime soon.
All right, folks, thank you all for joining us.